Good morning or good afternoon, depending on which time zone you're in. On behalf of Sikich, we'd like to welcome you to our webinar on Governmental Accounting Standards Board Statement number 84 on fiduciary activities. We have a wealth of information to share with you over the next hour, including some great examples on how this pronouncement may apply to your specific jurisdiction. We have over 100 participants in this webinar today from all across the country, from governments of all shapes and sizes, from general purpose governments to special purpose governments, and we have a lot of school districts and community colleges and technical colleges participating today. So welcome everyone. And we have folks that are serving in a variety of capacities, anywhere from a chief financial officer to accountants to even some administrative folks. Our goal with today's webinar is to assist you all in understanding the basic philosophy of GASB Statement number 84 and how this pronouncement may apply to your specific situation. Both of the instructors today are comfortable addressing questions throughout the presentation. If you have a question, please type it into the chat box and we will do our best to address the question throughout the presentation. If we do not get to your question during the presentation, we will do our best then to follow up with an email responding to your question after this seminar. Who is going to be our presenters today from Sikich? We're fortunate to have two distinguished guests with us today. The main presenter today is going to be myself, Fred Lance. I'm the partner in charge of government services here at Sikich. And for those of you who don't know me, I've been at Sikich for about 27 years now, heading up our state and local government practice. It's all I do year round is work in the state and local government industry. Prior to joining Sikich, I spent 10 years at the Government Finance Officers Association, serving as Assistant Director for the Technical Services Center. In that capacity, I served as one of the liaisons to the Governmental Accounting Standards Board from 1984 to 1992. You all have fun just reading the pronouncements. I got to have fun attending some of those board meetings and listening to 3 to 4 days of deliberations each month for about an 8-year period. Riveting excitement kept me on the edge of my seat every day. So overall, I have about 37 years in the state and local government industry, and my goal is to share some of that experience with you today. With me today is Anthony Cervini, and I'll let Anthony introduce himself.
Thank you, Fred, and hello, everyone. My name is Anthony Cervini. I'm a partner here at Sikich as well, working with our local government team. Excited to be here today and discuss the impact of 84. As Fred noted, a wide variety of entities and a wide variety of impacts.
Thank you, Anthony. Now, I know a lot of you are on the line today and on the web or attending the webinar to hear all about GASB Statement 84, but I know some of you are on the line today because this does qualify for 1 hour of continuing professional education credit. Not just 1 hour of CPE, but even better, 1 hour of Yellow Book CPE. Yes, that golden Yellow Book CPE in accordance with generally accepted government auditing standards. For those of you who do want to receive continuing professional education credit or CPE for attending this webinar, there's a couple of rules that we need to follow in accordance with the guidelines established by the National Association of State Boards of Accountancy, or NASBA for short, which are the guidelines that we follow. To qualify for CPE, you have to pay attention during the webinar, and to do this, and for us to monitor you paying attention, you have to write down 3 keywords that we will announce throughout the webinar. Jot down those 3 keywords, and then after the webinar, we will send you a survey to complete. Once you receive that survey, type in the 3 keywords into that survey and complete the survey, and we will send you your CP certificate as evidence of your continuing professional education. Those are the basic rules we have to follow. Any questions before we get started? If there aren't any questions, let's go ahead and get going because we do have a wealth of material to cover today. So what are we going to try and address today? Well, Anthony and I are going to do our best to help you determine if an activity is a fiduciary activity to report in a fiduciary fund, or if it's not a fiduciary activity, are you going to have to reclassify it out of your fiduciary funds, maybe to a governmental fund, such as a general fund or a special revenue fund, or perhaps you have something recorded in a governmental fund or an enterprise fund or internal service fund that may meet the definition of a fiduciary activity and therefore need to be reclassified into a fiduciary fund. So it can really go both ways in our analysis in implementing GASB Statement 84. In addition, we're going to determine which of the 4 fiduciary funds you might use to report a fiduciary activity. GASB 84 does define 4 fiduciary funds that we can use to report these activities. We're also going to talk about reporting custodial funds and the use of custodial funds. This is probably one of the most significant changes in the overall pronouncement with GASB Statement 84 and impacts the change from agency funds under the current standards to a custodial fund under the new guidance. In addition, it's going to affect how custodial funds are going to be reported, and we have a very good example for you to look at. In addition, we're going to talk about applying the alternative method for business type activity reporting, which may impact some of the community colleges, technical colleges, and other governments that might be on the line this morning, such as special districts, water authorities, and sewer authorities that only use a single business type activity fund to report on their overall operations and results of operations. Okay, the focus of our discussion is going to be GASB Statement 84. Statement 84 was issued in 2017, and it was issued to address a number of what we'll call challenges in our industry. Most notably was the fact that NCJ Statement 1, and remember, NCJ Statement 1 was issued back in 1979, so a long time ago, back when Fred was first starting in the industry, and that was modified by GASB Statement 34, but these defined fiduciary funds for us, but never defined fiduciary activities to be reported in a fiduciary fund. Due to this lack of guidance, we've seen a variety of inconsistencies in the industry as to what is reported in fiduciary funds versus governmental funds or proprietary funds, or perhaps not even reported at all. When I first started working in the industry a number of years ago, I actually worked with one community college in Illinois that used to report all of its grant funds in a fiduciary fund. Very, very creative use of a fiduciary fund. Well, Statement 84 is issued now to address all of that. Statement 84 is effective in the very near future. It's effective for fiscal years ending December 31st, 2019 and thereafter. So it's right around the corner for the calendar year and governments that are on the line today. Early application was encouraged, and we did assist the Village of Palatine. We'd like to thank Paul Maring and the folks at the Village of Palatine for early implementing this pronouncement for the village's fiscal year ended December 31st, 2018. While GASB Statement 84 is somewhat short, there's only 28 paragraphs to the pronouncement, so it's something you could probably read at your leisure, probably tonight when you're sitting out on your back patio enjoying our beautiful summer weather. However, it is a very, very complex pronouncement. Therefore, GASB recently issued GASB Implementation Guide 2019-2 on fiduciary activities to assist us in implementing this pronouncement. I can't encourage you enough to get a copy of that implementation guide. You can download it for free from GASB's website, gasb.org. But it's just a great, great tool to have while you're implementing Statement 84, and it really addresses a number of the technical issues in the pronouncement and how to apply them in practice. The implementation guide is effective at the same time as Statement 84, so they can be implemented at the same time. Okay, what GASB Statement 84 does for us is it basically defines for us what assets should be reported in a fiduciary fund. In order to accomplish that, Statement 84 generally gives us 4 paths of guidance that we can go down to make this determination. I call it the yellow brick roads to go down to determine if we have a fiduciary activity. The 4 different paths we can go on are a component unit that are post-employment benefit arrangements. A component unit is always defined by GASB Statement 14 as modified, and the term post-employment means, or post-employment benefit means, any type of pension plan or OPEB plan such as retiree health plan. So that's going to be path number 1. Path number 2 are component units, again meeting the definition of GASB Statement 14, that are not post-employment benefit arrangements. So it's a component unit that meets the definition of Statement 14, but perhaps it provides investment management services for other governments. Path number 3 then are post-employment benefit arrangements that are not component units. So it's a pension or an OPEB plan that does not meet the definition of a component unit, but yet still may meet the definition of a fiduciary activity to be reported in a fiduciary fund. Last but certainly not least, path number 4 is the one that frightens me the most. That's what we call all other activities, or the catch-all. This is really formerly agency funds, now custodial funds, and this is probably the path that is causing the most changes in practice and probably will cause the most challenges for you all in classifying something or changing classification for how something might have previously been classified in your financial statements. What accountant does not like a flow chart? I know all accountants like flow charts. So we put together a flow chart for you to determine which path to go down. And we always want to go down the right path, especially when we're discussing this with our children. So when should your government report assets in a fiduciary fund? Well, first we ask, are the assets held by a component unit? If we answer yes, then we say, are the assets held for a pension or OPEB arrangement? Yes, goes down path 1. No, takes us down path number 2. If the assets are not held by a component unit, so it doesn't meet the definition contained in GASB Statement number 14, then we will go down path number 3 if it's a pension or an OPEB arrangement, or if not, path number 4, which is really everything else, that catch-all path. So, okay, let's start with path number 1 and follow that yellow brick road down path number 1. So what does path number 1 tell us? Well, path number 1 in GASB Statement 84 says, if you have a component unit, so that's the first key definition, is it a component unit? And that component unit provides post-employment benefit arrangements. So component unit provides post-employment benefit arrangements through a trust that's defined by GASB Statement 67 or is defined by GASB Statement 74 on OPEB plans. Very, very simple. Or third bullet, the pension plan is not in a trust, but you have a fiduciary responsibility for administering the pensions for other governments. or the OPEB plan is not in a trust in the fourth bullet, but you have a fiduciary responsibility for administering OPEB assets for other governments. If you meet the first two bullets, you have a pension or an OPEB trust. If you meet one of the last two bullets, you probably have something in an agency fund, now a custodial fund, unless these are being held for your own employees and your own beneficiaries. Then those assets would be held in a governmental fund or some other non-fiduciary fund. So it's a very simple, straightforward approach to path number one, a component unit that provides post-employment benefits. Path number two then are component units that do not provide pension or other post-employment benefits. So then we have to look at three different criteria. So these component units would be fiduciary in nature if they meet one of the following three criteria. The fiduciary assets are administered through a trust agreement or equivalent arrangement in which the government itself is not a beneficiary. It's a very, very key component to that definition. The government itself is not a beneficiary. What that tells us is that you can never have your own assets, your government's own assets, in a fiduciary fund. The assets are dedicated to providing benefits to recipients in accordance with the benefit terms, and they're legally protected from the creditors of the government. Okay, that's basically a very, very simple approach. The second bullet, so there's an or statement there. The assets, again, are for the benefits of individuals, and the government does not have administrative involvement with the assets or direct financial involvement in the assets. This criteria is applied throughout GASB Statement 84, the administrative involvement and direct financial involvement, and was clarified very, very well in the implementation guide. So we're going to focus on that definition just a bit. In addition, the assets are not derived from the government's provision of services or goods to those individuals, another key criteria used throughout this standard. Last but certainly not least, the assets are for the benefit of organizations or other governments that are not part of your financial reporting entity, and the assets aren't derived from your government's provisions of goods or services to those organizations or to the other governments. If you meet any one or more of these, the component unit would be reported as a fiduciary activity. If you don't, that component unit would probably be classified as something else within your financial statements. And that brings us to the time for our first keyword. So our first keyword for today is fiduciary. We thought that would tie in very, very well with the topic that we're discussing today. So please make sure you write down that first keyword, fiduciary, and type that into your evaluation at the end of the session to receive your continuing professional education credit. Fiduciary going once, fiduciary going twice, fiduciary going 3 times, and it is now gone. Okay, let's go back to those concepts of administrative involvement or direct financial involvement. So what are some examples of administrative involvement? Well, believe it or not, these come from GASB Statement number 24 on accounting and financial reporting for certain grants, specifically what we call pass-through grants. And basically, GASB was trying to determine, would the pass-through grant qualify for reporting in just an agency fund? Or if you had any administrative or direct financial involvement in it, meaning you had some level of control over those funds, then you had to report those in a governmental fund as opposed to a conduit type. So the criteria that we use is, does your government monitor compliance with the requirements of the activity that are established by your government or by a resource provider that does not receive the direct benefits of the activity? So any type of monitoring, or if you're on the hock for question costs or any findings that might result from any type of audit process, that would say you have administrative involvement. Does your government determine the eligible expenditures that are allowed, either your government or a representative of your government? So for a school district, that could be an administrative person, a principal, the principal's administrative staff, whoever it might be. If they're determining eligible expenditures or approving the expenditures, then they probably have some type of administrative involvement. Last but certainly not least, does your government have the ability to exercise discretion in how the assets are allocated? For example, if you're a college and you collect student activity fees and you determine how you allocate those out to these student clubs, that again would be a key component in the definition of what we call administrative involvement. So those are some good examples of administrative involvement. Basically, if you have any control over how the assets are deployed or how the assets are used or approval processes throughout, that would basically tell you have a direct administrative involvement. A direct financial involvement would be something along the lines of, do you have to match any resources that might be raised by that separate entity? So that's how we define administrative involvement or direct financial involvement. Very, very key definitions, so please make sure you understand those as we're going to repeat those and come back to those throughout the presentation. If you possess any of these powers, you have administrative or financial involvement, the activity is probably not a fiduciary activity, don't pass go, don't collect $200, do not classify that as fiduciary activity, just report that in probably a governmental fund or a proprietary fund, as it's part of your normal operations and part of your normal funds classifications. I didn't think we would have to do this, Anthony, but we're actually going to have to take a walk down history lane and talk a little bit about GASB Statement number 14 in order to better understand the two criteria that we just went through of a fiduciary component unit. So how do we determine if we have a fiduciary component unit? Because Statement 84 did not define that for us. Instead, Statement 84 kicks us back to GASB Statement number 14. How many of you were in the industry when GASB issued Statement 14? Okay, not a lot of raising our hands. Well, Statement 14 has been amended by GASB Statement number 39 on related organizations and GASB Statement 61, as well as various implementation guides over the year that change regularly some of the definitions. Therefore, I found it almost a necessity to use the GASB codification for an analysis of whether or not an entity meets the definition of a component unit to make sure you encompass all the changes that have come about to GASB Statement number 14 over the years. So the first question we have to ask under GASB Statement 14 is this separate entity a legally separate entity? That's the first key definition. If it's not a legally separate entity, meaning it doesn't possess its powers that it needs to operate independently, then we don't even consider it a component unit. Instead, if it gets its overall legal authority from the umbrella of the primary government, then it's just part of that primary government. So we don't even go any further in that definition. However, if it is a legally separate entity, then we have to look at, are we financially accountable for that entity? And financial accountability can be met by one of two sets of criteria that we have in the slide here. The first sets of criteria are the first two bullets that you see. So financial accountability can be met for this legally separate entity if we, the primary government, appoint the voting majority of that component unit board, and, so there's an and there, and the primary government, we can impose our will on the component unit, or the component unit provides a financial benefit or burden on the primary government. So that's the first key for our definition under GASB Statement 14. Do we appoint a voting majority of the board? And can we impose our will upon them, or is there a financial benefit or burden? If we don't meet those two criteria, then the next way we define financial accountability is the component unit is fiscally dependent on the primary government, or the component unit provides a financial benefit, or I'm sorry, there's an and there. So the component unit is fiscally dependent on the primary government, and the component unit provides a financial benefit or burden on the primary government. GASB Statement 84 did note that if you, the employer, are required to contribute to a pension or an OPEB plan, that in and of itself meets the definition of a financial burden, the sole fact that you have to make an employer contribution to that plan. So therefore, it really comes down to board appointment or fiscal dependency to determine if this legally separate entity is a component unit of the primary government, at least as it relates to a pension plan or an OPEB plan. Let's walk through those definitions a little bit further. First, on board appointment. Board appointment, we have to kind of look through the composition of the board and say, do you, the primary government, appoint a voting majority of that board? Not just a simple majority, but it has to be a voting majority. Now, sometimes boards might be appointed not by our board, but perhaps through a different selection process, especially with pension funds and OPEB plans. If the appointments are made by, say, employee groups or retiree groups, that would not meet the definition of a board appointment by the primary government. So you have to be very, very careful in applying that. And again, GASB has provided some good guidance and some recent implementation guides on that specific topic. Well, what if we're in a situation where no board exists? For example, we have a 457 plan, an IRC 457 plan at a local government where there is no board. Or perhaps we have a 403B plan or some other type of tax deferred plan for employees where there is no board. Well, in that instance, if there's no board, then we have to determine, is our primary government board, our city council, our community college board of trustees, whatever it might be, are they in ex officio capacity serving that capacity by creating that fund or creating that benefit plan? So that's how we determine appointment of board, and whether or not, again, the key is, do we, the primary government, appoint a voting majority of that board? If we answer no to, or if we answer yes to that, then we have to ask, do we impose our will? Imposition of will, basically, can your government impose its will on that potential component unit? We have a variety of criteria that we can go through to look at that. Specifically, can you influence the programs, projects, activities, or perhaps even the levels of services that are provided by the other entity to the constituency? or to their beneficiaries? Do you have the ability to remove any appointed board members at will, regardless of their performance? Do you have the ability to modify or approve the budget of that separate entity? Do you have the ability to modify or approve their rates or their fees? Or do you have the ability to appoint, hire, reassign, or dismiss anyone that's responsible for the day-to-day operations? Basically, do you function as the management of that entity in that instance? If you appoint the voting majority of the board and you can impose your will on the entity as we've just defined, or a financial benefit or burden exists, then the unit may meet the definition of a component unit, and therefore, if we met the other criteria from slide one, or I'm sorry, from path one or from path two, a fiduciary component unit to be reported in a fiduciary fund. Let's move to the next criteria under GASB Statement 14. And the next criteria is fiscal dependency, or looked at differently, fiscally independent. So is that component unit or potential component unit fiscally independent of the primary government? So again, we don't appoint the majority of the board, but we may still have a fiduciary component unit. So the criteria from GASB Statement 14 are on your slide. Understand those criteria were written more from a special purpose government standpoint and really were written from a pension and OPEB plan standpoint. So we kind of have to look through some of those criteria to determine whether or not we meet these criteria. The first criteria for fiscal dependency is, can that potential component unit determine its own budget without another government having authority to approve or modify that budget? Well, most pension and OPEB plans have no authority to adopt an appropriation. There is no such thing. Generally, a local government or the sponsoring employer would appropriate that pension plan or that OPEB plan. So we might look at that as de facto appropriation authority. I would also look to whether or not that pension plan can determine and approve their own benefits without approval by another entity. That to me is de facto budgeting for a jurisdiction or for a pension or OPEB plan. Do they have the ability to determine their own benefits? Even if they're in accordance with state statute, they have to follow the guidelines in state statute. For example, police and fire pension plans in Illinois, yes, they approve their own benefits at the board level, but then believe it or not, it's actually written in compiled statutes that the municipal treasurer, either on the city side, a village side, or fire protection district side, the treasurer of the employer has to approve those benefit calculations once they're done by the board over that pension fund. So in that instance, you might say there's a certain level of fiscal dependency because that approval process going back to that employer. Can the pension fund levy, or the OPEB fund, or any other type of component unit levy taxes or set rates or charges without approval by another government? In this instance, we have to look at, can the pension or OPEB plan or this potential component unit determine the contributions going into the plan, or does the primary government or the employer possess that power? Last but not least, we're told to look at issuing bonded debt. Can that potential component unit issue bonded debt without the approval by another government? This is really not applicable for most pension and OPEB plans. Very few, if any, have budget authority. But GASB did note in Statement 14 as amended that a special purpose government that is statutorily prohibited from incurring debt, so by statute they can't incur debt, can still be fiscally independent if it possesses the other two powers, because the statutory prohibition does not subordinate the special purpose government to another government for debt approval. Also, GASB 14 notes that the approvals must be substantive approvals, where the approving government, your government, can make changes to the amounts versus just administrative approvals, whereby you have to approve the amounts and really cannot modify them, just approve whatever that separate entity or that separate board has presented to you. A special purpose government, including a pension plan or OPEB plan, must possess all of those characteristics to be fiscally independent, except for that statutory prohibition of issuing bonds. If the primary government or the employer holds any of these powers and a financial benefit burden exists, then the unit may meet the definition of a component unit and therefore a fiduciary component unit to be recorded or reported in accordance with GASB Statement 84. So that was our first two paths. Wasn't that fun? Okay, let's go down paths 3 and 4 now. And again, we're going to look at that same slowly progressing flow chart. So now we're on the paths 3 and 4. So we've determined this is not a component unit. So now we ask ourselves, okay, we don't meet the criteria of GASB 14, but are the assets held for a pension or OPEB arrangement? If yes, we go down path 3. If no, we go down path number 4. So let's take a walk down path number 3 then. And notice how we have those little bullets on the top of the slide that correspond to the paths, so it makes it a little easier for you all to follow along. Okay, path number 3. So now we have a post-employment benefit. So again, some type of pension or retiree health plan, but it's not a component unit. but we're still going to treat it as a fiduciary activity if we control the assets, meaning you, the primary government, control the assets of that activity, and the activity meets one of the following definitions. These are the same definitions that we went through on the previous slide. A pension plan that's administered through a trust that meets the criteria of GASB Statement 67, which is on pensions. An OPEB plan administered through a trust that meets the criteria in paragraph 3 of Statement 74, again on OPEB plans. Or the last two bullets, which again was the same from slide on path number 1. So how do we determine if you control the assets or your government controls the assets of this separate activity? That's right, we do have a slide for that. So if we look at the next slide, on the next slide, we go through that definition of control. You can control the assets of an activity if you hold the assets. So does your government hold the assets? Are the assets recorded in one of your accounts, an account that's titled into the name of the employer or the name of the primary government? Or do you serve as custodian of those funds? And believe it or not, in Illinois compiled statutes require the treasurer of the municipality or the city to serve as custodian of the pension fund's assets. Little known component of Illinois compiled statutes. Last but certainly not least, the second criteria or the second definition of controlling the assets is, does the government have the ability to direct the use, the exchange, or the deployment of those assets in a manner that provides benefits to specified or intended beneficiaries? So can your government control how those assets are invested, how they're used, or how they're deployed, or does the plan or its beneficiaries possess that ability? Think of a 457 plan or some other type of defined contribution plan, such as the 457, 403B, or anything else like that, where the investments of the assets are controlled by the beneficiary, but not controlled by the primary government or the employer. It's a good way to look at that criteria. So if we meet either of these two criteria, either the government holds the assets or we have the ability to direct the use, deployment, or exchange of those assets, and it's a pension or an OPEB plan, then we meet the definition of a fiduciary activity. So again, this would be a pension or OPEB plan that did not meet the definition of a component unit, but still meets the definition of a fiduciary activity because we control the assets of that activity. Again, control is a very, very important component to that definition. Okay, if you're all set on path 1, path 2, and path 3, let's go down path number 4 for a minute or two and talk about path number 4, because this is the one that I think is really going to have an impact on a whole lot of us. So, okay, so now we're talking about all other activities within your jurisdiction. So we have to look at not just what you have recorded in a fiduciary fund today, but perhaps what you have recorded in a governmental fund. For example, I have a client that collects impact fees on behalf of other governments. I have a lot of clients that do that. A lot of governments will account for that collection of fees on behalf of other entities in an agency fund or a custodial fund. But this one particular government that I work with, they don't use an agency fund to account for those monies they collect for other governments. Instead, they just report that in an escrow account within one of their capital project funds where they have the other fees that they collect for themselves, the other impact and development fees. Going through Statement 84 now might require them to reclassify those out of that capital project fund and put those in a fiduciary fund if they meet this definition that we're going to walk through now. So I can't emphasize enough, we can't just look at what's in a fiduciary fund now, we have to also look at what's not in a fiduciary fund, but in one of our other funds that may need to migrate over to a fiduciary fund. So again, I think this path number 4 is going to cause the most changes in most of your reports as you go through and do this analysis. Okay, so what do we have in path 4 for this catch-all or default category? And I think that's a good way of thinking about it, or defining it. It's kind of the default category for fiduciary activity. So an activity on this path, path number 4, must meet all of these criteria that we're going to go through to be classified as a fiduciary activity. So first and foremost, as you see on this slide, the government has to control the assets. Well, again, to control the assets is the same definition that we just reviewed. So you either hold the assets in one of your accounts, or you have the ability to direct the use, exchange, or deployment of those assets in a manner that provides benefits to the beneficiaries or the intended end users of those. So no different from the definition of control, but then we have to go through these next two criteria. Notice there's a not here. So these assets are not derived. So it's real important we understand that. So the assets we're evaluating are not derived from, first and foremost, the government's own source revenues. Well, what is an own source revenue? Own source revenues are revenues that you or your board control and or determine and or approve, such as your own tax levy, your own user fees, your own student activity fees charged by a college, or an activity or additional fee assessed by a school district. I don't have any children in school anymore. My youngest son graduated from high school a little over 2 years ago, but boy, I certainly remember all the fees that we had to pay as part of that annual school district. I thought I was done when I paid the property tax bill supporting that public school district, but boy, the fees that we had to pay were really quite amazing. So if all those fees are approved and determined by that school district's board, they're part of their sole source revenues or their own source revenues. So any revenue that you control basically is going to be your own source revenue. If these own source revenues are from your government or ultimately revert back to your government, then the definition of a fiduciary activity is not met. You don't have to go through any of the other criteria, and you're not going to report this activity in a fiduciary fund in the future when you implement GASB Statement 84. So that's the first key focus. And you might have a fiduciary activity now that combines your sole source revenues with other governments' sole source revenues. Can you continue to report your sole source revenues in that fiduciary activity commingled with the other government's sole source revenues? The answer is no. You can never report your own sole source revenues in a fiduciary activity. So it's very, very important that everyone understands that definition. Sole source revenues can never be accounted for in a fiduciary activity. Okay, second definition or second component of that same, the assets are not derived from government mandated non-exchange transactions as defined by GASB Statement number 33, or voluntary non-exchange transactions with the exception of pass-through grants. So again, GASB was trying to keep intact that whole definition from GASB Statement 24 on pass-through grants to still allow pass-through grants to be accounted for in a custodial fund. Although as Anthony's going to show us in just a few minutes, the accounting for a custodial fund is so similar to the accounting for a special revenue fund or the general fund, I'm not sure why you try and force something into a custodial fund into the future. Last but certainly not least, your government does not have any administrative involvement or direct involvement in those assets. So just like before, we said you don't have administrative involvement or direct financial involvement. These are the same definitions. So again, if you have a student club or a student activity where the principal or someone else or the school board is approving what they can spend their money on, that is administrative involvement. If you provide matching dollars to fundraisers for a student activity, that is direct financial involvement. The same definitions that we went through before. So again, if you have administrative involvement, direct financial involvement, or they're your own source revenues, don't go any further. You do not have a fiduciary activity to report in a fiduciary fund. However, if we meet all these criteria, then we can continue going down this path, follow the yellow brick road, and then we have to go to the next slide then to determine if we meet any of the criteria on the next slide. Now, I know that slide's a little busy, so I apologize for that. We'll kind of go through it in a little slow detail. So we don't have to meet all three of these bullets, just any one of these bullets, plus the criteria on the previous slide for path 4. So let's go through the first bullet. The assets are administered through a trust agreement or equivalent arrangement in which the government itself is not a beneficiary and is dedicated to providing benefits to recipients in accordance with benefit terms, and they're legally protected from the creditors of the government. Boy, that sounds a lot like a private purpose trust, as Anthony's going to define for us in just a few minutes. So that'd be that first definition. The second definition, the assets are for the benefit of individuals, and the government itself does not have administrative involvement with the assets or direct financial involvement with the assets. So again, we're looking at that criteria of administrative involvement or direct financial involvement. In addition, they're not derived from your government's provisions of goods or services to those individuals, so it's not part of your tuition and fees that you charge to those individuals. Again, the same definition of administrative involvement or direct financial involvement that we saw on the previous screen. Last but certainly not least, the assets are held for the benefit of organizations or other governments that are not part of the financial reporting entity. In addition, the assets are not derived from the government's provisions of goods or services to those organizations or to other governments. That sounds a lot like custodial funds used to collect fees and taxes for other governments or other entities. And that's probably the best example of that definition that we could provide you. So if you meet these two criteria on the previous slide and any one of the criteria on this slide, you have met the criteria of path number 4, and the activity meets the definition of fiduciary activity. Again, if you did not meet the criteria on the previous slide or the criteria on this slide, you do not have a fiduciary activity and cannot report that in a fiduciary fund. I hope you all are having as much fun as we are. Remember, GASB puts the D in fund accounting for us. And that brings us time to our second keyword for today. The second keyword, sticking with the theme of what we were just discussing, is pension. So again, if you want to receive continuing professional education, you need to go ahead and jot down that third keyword and then type that in into the evaluation when we send that to you to receive your continuing professional education credit. I don't believe spell check is built into the evaluation form, but don't worry, if you misspell a word, as long as you're close, we'll go ahead and consider that the keyword and give you credit for that. Kind of like the enunciation of the words on what's that one game that they play on TV? One of my favorite names favorite games where they turn the letters on the screen. So I'll think of it in a few minutes. So, okay, did y'all jot down that second keyword? If you did, let's talk about now how to report those fiduciary activities. So we've gone through all the criteria to determine if we have a fiduciary activity. So let's say we've answered yes to some of those, and now we have a fiduciary activity. What do we do with that? For that portion, let's turn everything over to Anthony.
Thank you, Fred. Now, Fred's done a yeoman's job of giving us the various paths that we're taking to look at our fiduciary activities here. So at the point now where we've met one of these paths, we then need to make the determination of how we're going to report this fiduciary activity. Now, the first three categories here should look pretty similar to any of these paths being met. So our pension or other employee benefit trust fund, an investment trust fund, a private purpose trust fund. Then we get to where the change really comes into play is that last final bullet point here, a custodial fund. Custodial funds replace agency funds, and it's important to know with the custodial funds that these are not something that we're not just changing the name. There's some really substantial changes that we'll go through in just a few slides here in terms of what's happening with the custodial fund treatment. So in terms of our fund definitions, let's revisit those. So pension and other employee benefit trust funds, again, are going to be used to report fiduciary activities in the following circumstances. Pension plans and OPEB plans, again, that are administered through trust that meet the criteria in either paragraph 3 of Statement 67 or paragraph 3 of Statement 74. And then other employee benefit plans for which one, and these are two important criteria here, again, those assets are held in a trust in which the government itself is not the beneficiary. The assets are dedicated to providing benefits to recipients in accordance with those benefit terms and are legally protected from the creditors of the government. And two, those contributions to the trust and earnings on those contributions are irrevocable. So again, that irrevocable contribution there. Investment trust funds, our second category, are used to report fiduciary activities from the external portion of investment pools and individual investment accounts that are held in trust that meets the specific criteria, again, dedicated and protected source there. Private purpose trust funds, as Fred noted earlier, are used to report all fiduciary activities, and these are not required to be reported in pension or other employee benefit trust funds or investment trust funds, and are held in a trust that meets the specific criteria, again, dedicated and protected, and cannot be used for the government's programs. And finally, our changed category, custodial funds, we're going to use these to report fiduciary activities that are not required to be reported. And again, pension or other employee benefit trust funds, investment trust funds, or private purpose trust funds. So just like path 4 was our catch-all, custodial somewhat becomes our catch-all in terms of our fund definitions here. So how are we going to report fiduciary funds? How are we going to, what changes are coming into place with some of these? Well, fiduciary funds are reported on the accrual basis of accounting and using our economic resources measurement focus. Looking at fiduciary funds, when are we recognizing liabilities? Liabilities are recognized when we have a liability to the beneficiaries in a fiduciary fund when an event's occurring that compels the government to disperse the fiduciary resources, as well as events that compel a government to disperse fiduciary resources when a demand for the resources has been made, or when no further action, approval, or condition is required to be taken or met by that beneficiary to release those assets. So in an example here, a county would recognize a liability when it collects taxes for other governments, even though it may not be required to distribute those taxes to those governments for a prescribed period of time. Liabilities also, other than those to beneficiaries, should be recognized in accordance with the existing accounting standards, again, using that economic resources measurement focus. So what are our financial statements? Again, major changes here are going to be that final bullet point. We still have our statement of fiduciary net position. We still have our statement of changes in fiduciary net position. But the important thing to note here is that this applies to all fiduciary funds, including custodial funds. So in the past, our agency funds, or the funds formerly known as agency funds, we used to report those, and all we would have is a balance sheet for those. We'd have offsetting assets and offset by liabilities for that. So for example, if you had a special service area, you'd have your cash, you'd have your due to bondholders amounts most likely, or due to others as part of those amounts that are reported there. Under GASB 84, custodial funds now have a income statement affiliated with them, a major change in terms of the reporting model for that. So Fred mentioned earlier the Village of Palatine, who early implemented GASB 84 for the statement, or for the period ending December 31st, 2018. So let's take a look at a couple of their financial statements here and see what those changes actually entailed. So the statement of net position for proprietary, or for fiduciary funds, excuse me, your pension trust fund and custodial funds here are the two types that are reported by the village. Again, these are reported in separate columns based on the fiduciary fund type here. So in this case, the pension trust fund, very similarly reported to how it has been in the past, really no major changes in terms of this presentation. Where the change comes into play is the custodial fund here. And looking at the custodial fund, the amount, we now have a net position amount restricted for debt service in that custodial fund. Historically, that would have been up a few rows up in the liability section there. So again, changing that from a focus standpoint, moving that from a liability on the balance sheet down to the equity section. On the income statement side of things, major changes here as well. Again, our pension trust fund, very similar on the pension trust fund standpoint, but now we have a custodial fund. Now you might be thinking, Anthony, we've had income statement type presentations for our custodial funds in the past, and that's true. However, this is now required as a basic financial statement as opposed to the past where you may have had a supplemental schedule showing the changes in the additions and deductions in your agency fund. So a pretty significant change, again, in terms of this presentation and how this looks here. So again, your custodial fund here, you have your additions, you have your deductions, and then coming down to a net position. You'll see in our example here that the net position was restated as at the beginning of the year at Palatine. A couple of things that they had reported previously as agency funds, when they went through and did the assessment under GASB 84, determined that those things no longer qualified for presentation as a fiduciary fund. So those were removed from the reporting presentation for that. Specifically in Palatine's case, they had a line of credit escrow or letter of credit escrow account and a Section 125 health related plan for that. So they no longer have those reported there. The only thing remaining in this presentation is their special service area fund. Fred mentioned earlier that GASB 84 has some treatment and that guidance in terms of standalone business type activities. So a standalone business type activities, fiduciary activities should be reported within separate fiduciary fund financial statements. Some, I think, long awaited guidance that we got from GASB in this realm that we really didn't have anything in the past on that. As Fred noted, there was quite a bit of inconsistency in practice on how those items were reported for that. So GASB did give us the context in terms of how those should be reported. But like any good standard, GASB gave us an exception as well for this and said resources that are expected to be held 3 months or less can be reported instead in the statement of net position, with those inflows and outflows reported as operating cash flows within the statement of cash flows. So we spent most of our session today so far going through a lot of the technical details behind the GASB 84, the changes, the definitions associated with that. What we want to close out with is going through some specific examples for you and really highlighting what this means, how this is going to impact your entity or how this may impact your entity. We've tried to come up with a variety of examples here that hopefully one or multiple examples that we go through will be relevant for you. So let's start off looking at a deferred compensation plan, an employer-sponsored deferred comp plan. In our example here, we have no board that exists. So by default, the employer board is serving in that capacity. We, the employer, are hiring the investment managers providing investment alternatives to our employees. Our plan assets are held in a trust. We as the employer have no requirement to, and we don't contribute to the plan. And finally, the employees and the plan members are contributing a set percentage of wages up to a maximum amount. So what questions are we going to ask ourselves as we look at GASB 84 and the impact of it? First, does the deferred compensation plan meet the definition of a fiduciary component unit or a fiduciary activity? The answer here is no. While the appointment of the board itself is unclear, there's no financial burden to the employer as we're not contributing, and there's no imposition of will from the employer standpoint. Now, we can ask ourselves the question, would this change if the employer had a requirement to contribute to the plan? And it may. GASB actually just recently issued an exposure draft on Internal Revenue Code section 457 for deferred comp plans, and did make some changes in terms of how that's looked at there. So something that we may be changing down the road for us in terms of the impact of that plan if we do have that required contribution.
What GASB Statement 40, or the new exposure draft on GASB Statement 47 is really focusing on, on 457 plans, which is amending GASB Statement number 32, Anthony, they're really kind of focusing on, is it a pension plan or is it a deferred compensation plan? With a deferred compensation plan, the employer doesn't make any contributions. You're just creating a plan that gives the employees the opportunity to defer taxes on some of their earnings. That's why it's just a tax deferred plan. Basically, what most 457 plans, a lot of 403B plans and things like that, gives the employee the ability to put aside some of their wages on a tax deferred basis. However, it becomes a pension plan as GASB defines in this exposure draft, and they kind of kick it back to GASB Statement GASB Statement 67 on a pension plan. They say as soon as the employer is required to make a contribution to that plan, it goes from being basically a tax deferred type plan into more of a pension plan. I thought that was a real interesting analysis. Now, that doesn't mean that just because it's a pension plan, it's going to come into your financial statements. We still have to go through the other criteria of GASB 84 that we just went over. So just because GASB is saying it's now a pension plan doesn't automatically kick it into a pension trust fund. We still have to go through that criteria. So
that's a great clarification, Fred, and I think really important to take away from 84 and the impact of 84 and some of the other changes coming down the pike with GASB is just really taking a kind of a deep dive on the programs that are offered at your entity for that and making the determination and working with your auditors and looking through to determine what this treatment should be on this, so you do have the proper accounting and financial reporting in place for that. So looking at our next example, Fred mentioned impact fees, and we see this for developer deposits, other types of fees along those lines. So in this example, our municipality is collecting deposits from developers when plans for new constructions are submitted to the municipality for review. Our deposits are being used to secure the payment of those plan review fees, legal fees, and if approved, permit fees by the developer that are going to be owed to the municipality. We're going to hold these funds in one of our demand deposit accounts. And then ultimately, if everything kind of goes according to plan, the funds will be returned to the developer upon completion of the review or used for payment to the municipality should the developer not complete their end of the bargain, or if those are not reimbursed by the developer on that. So again, asking ourselves the question, can these deposits from developers be accounted for in a fiduciary fund? In this case, it's a resounding no, because the plan review, legal, and permit fees that the deposits are securing are all affiliated directly with our own source revenues. Again, we made that differentiation earlier in the slides and the roadmap for you there. So again, looking at those and determining if it's an own source revenue, then it cannot be in a fiduciary fund.
So Anthony, even though these assets, even though we control the assets because we have them in our own accounts, we don't meet that definition of fiduciary activity.
Correct.
Interesting. So again, if you go back to that previous slide, I think it was slide 18, you can't pass go and collect that $200 if it's coming from your own sole source revenues. It's an excellent example.
And really important differentiation. Again, those own source revenues really, kind of stop you flat in your tracks there. All right, that brings us to our final key word for our session today. The final key word is trust, and trust me, it is the final key word. You can trust us on that. So as Fred will tell you, there's no such thing as good auditor humor. So we try our best for you here. Our final key word is trust. Again, if you do need CPE and Yellow Book credit for that as part of the survey process. Please make sure you do have those keywords down and include it as part of your survey. We'll give you just another 10 seconds here to make sure you got that jotted down before we finish up here with our final set of examples.
Before we get to those final set of examples, Anthony, we did have a question come in. Should we go ahead and address the question after the keyword?
Absolutely. Let's go ahead and do that.
Okay. Going back to the slide that you had on the definition of a liability. So I believe that was slide 24. The question was, should the pension liability, the net pension liability, or the net OPEB liability be recorded in the pension fund or the OPEB fund, or should that be recorded in the employer's financial statements?
Great question, Fred. And in this case, it's not a liability of the fiduciary fund, it is a liability of the overall entity itself. Therefore, you would not have those liabilities reported within the pension or OPEB trust fund, because again, it's a liability of the municipality, a long-term liability, so generally reported in your long-term debt account group and reported as a long-term liability of the entity, the sponsoring entity for that plan, as opposed to it's not a liability of the fund itself. Generally, your fund level liabilities in a pension or OPEB trust fund are going to be related to your general accounts payable or items related to kind of standard amounts in that end.
Or benefits that are owed but not yet paid.
Correct.
So again, we wouldn't expect to see a whole lot of liabilities in a pension fund. It's a very, very interesting question, and thank you for that question. And it goes back to the whole philosophy of, if that fiduciary fund ran out of money, who would ultimately have to pay that liability?
Who's on the hook for that?
Would it stay with the fiduciary fund's board, or would it revert back to the employer? And in that instance, it definitely reverts back to the employers.
Absolutely. So looking at an example that's likely relevant to most of our participants today, let's look at tax collections and how this is going to be impacted under Statement 84. So in this case, we're a county and we're going to collect property taxes on all taxable property within our boundaries. Now, as part of those property tax collections, we're collecting amounts both for ourselves as well as the other taxing bodies. Those property taxes collected and held for other governments are commingled with the taxes collected for the county, and we're not holding those in any sort of trust or equivalent arrangement. We're holding those in separate demand deposit accounts, and then the taxes that we are collecting are being distributed to all taxing bodies at regular intervals, and we're doing that at least on a bi-monthly basis. The question we ask again, should those property taxes collected be accounted for in a fiduciary fund? And in this case, the answer is yes. The taxes collected for other governments meet the definition of a fiduciary activity because we control the funds and they're held for other governments, and we're going to use a custodial fund in this case to report those amounts. But an important differentiation here can be a major change in terms of how a lot of counties do this reporting and do this tracking. Property taxes that the county collects for itself cannot be reported in the custodial fund. Again, we go back to that own source revenue definition there and look at that and say, okay, well, the county is going to have to look at this. So we take that one step further in a county government in terms of amounts that, county governments often have a court system affiliated with them. Those court fines that are coming in for that oftentimes are tracked in a separate fund, especially here in Illinois, a clerk of the circuit court fund for that. Now, a lot of those dollars do end up being paid, whether they're to the state or the arresting entity or the ticketing entity for that. However, a large portion of those dollars do make it back to the county. So you're going to have to make a differentiation of what amounts are related to going to other parties and what amounts are actually going to the county itself as an own source revenue. So again, an important differentiation looking at that. A couple final examples looking at our student activity fund. So in this case, an educational district is collecting student activity fees on each credit hour as a part of our tuition and fees. These fees are used to support a variety of campus needs and activities, and certain amount of fees are distributed to the student government to be divided and allocated among the student clubs for their use. Now, some clubs do have the ability and do generate their own additional revenue through fundraising activities on campus or throughout the course of the year. And other clubs are financing solely from those allotted student activity fees, so they don't have any additional fundraising activities that are occurring during the course of the year. In this example, we're holding the funds in one of our demand deposit accounts, and we're dispersing those funds to the respective clubs upon approval by an academic advisor to that club. The student club amounts are not held in trust or trust equivalent arrangements, nor are the student club's component units. So in this example, do the student activity funds meet the definition of a fiduciary activity? And the answer is no. The student activity fees are, again, own source revenues to the district here. If you think about this, we're also approving the amounts and have a heavy administrative involvement in this process as well. So a lot of the things that we're looking at as part of that definition. So again, looking at that own source revenue, we keep coming back to that point here, but really a focal point of the standard itself.
Anthony, before we go to the next example, we do have a question on this example. And the question was, what if the funds in the student club were not derived from student activity fees? So in other words, the clubs were generating their own revenues, and we're not receiving anything from the college. Would the answer change in that instance? I'll go ahead and address that one. You said that the student activity fees are their own source revenue, so we took that out of the equation. So if we follow the rest of the guidance, we control the assets, we hold the assets, so we meet that definition of control under path number 4. But then we have to ask ourselves, do we have any administrative involvement or direct financial involvement in those? Again, if we have any administrative involvement or direct financial involvement, it doesn't meet the definition of a fiduciary activity, just like with that sole source revenues. So the sole fact that the funds are dispersed by the student club upon the approval of by the academic advisor to the student club, meaning an employee of the college or an employee of the school district, that also says we have administrative involvement, and therefore would not meet that definition of fiduciary activity. So
absolutely, Fred, that's a great example. As you know, kind of pointed out here, there are certain cases where those funds may not be coming from our activity fees that we're drawing on that, but again, we likely will, often will end up at the same place there based on other, the structure of that agreement there. All right, our final example for you then is just looking at a resident fund here. So in this case, we have a nursing home accounted for as an enterprise fund, a business type activity, and has a nursing home residence fund used to account for the collection of monies from patient sources to be used by those residents to purchase personal items. Funds are held within one of the bank accounts of the nursing home, and the patients have full say in how those funds are used. In this case, do we have these resident funds? Are these fiduciary funds? And in this case, yes, the patient funds meet the definition of fiduciary activity. Why? Because the nursing home controls the assets. The assets are not derived from our own source revenue, and the assets are for the benefit of individuals, and the nursing home does not have administrative involvement with the disbursement of or direct financial involvement with those assets. How would we report these? These would be reported in a custodial fund as no trust exists, unless, and again, we go back to our exception that we highlighted earlier, those funds are dispersed within 90 days of receipt by the nursing home, then they can fall into that operating section from business type activity model for that.
Just to make sure I understand this one, Anthony, because this is a little complex. So if I'm a business type activity, whether a nursing home issuing my own financial statements or a technical college in Wisconsin or a community college in Illinois following the business type activity model where I present just one column for my basic financial statements, or even a water authority or sewer authority or something along those lines. So if I now have a fiduciary activity classified as a fiduciary fund, I can't just consolidate that with my business type activity like I might have done in the past. I actually have to have a separate column in my financial statements called fiduciary activity. And my auditor's going to assess materiality at that column level?
They will, Fred. That's absolutely, that's a great point. They're in a pretty significant change in terms of the reporting that we've had for this. So again, understanding that context and what that looks like and being able to, go through and assess the operations at your entity and make that decision. As Fred noted earlier, GASB does have a pretty recently issued implementation guide on that. We did put that on the materials section for you today, so you can download that directly from today's presentation on that. And with that, 12:59, so we're right on time here. That concludes our webinar for today. Again, I want to thank you for taking time out of your day to participate with us and be part of our webinar here at Sikich. Again, if you have your 3 keywords written down, the survey will be coming out to you and be able to fill that information out. Do have another webinar coming up in November on that, so be on the lookout for more information on that. We'll have information available as that comes to be. With that, have a great afternoon, everyone, and thank you again for participating.
And if you have any questions, please feel free to reach out to Anthony or myself or any of the partners or managers at Sikich with any of your questions. We'll be happy to address them for you.